Investors set to wrap up 2024 with big gains despite weakness on Wall Street at the end of the year. Even today, we're seeing stocks lose steam heading into the close, but our next guest sees this weakness as a buying opportunity. Joining us now is Dory Wiley, Commerce Street Capital CEO and President. Dory, you were just listening to us talk about the market. Why don't you just give us your big picture 30,000-foot overview here of what's happened in 2024 and what you see for the next month?
Sure. Well, nice to be here, Jared. Thank you. And hello, Julie. And nice summation. I love the way you guys have those charts and stuff. They're so readily available. I need that screen at home. But I think what we're seeing here is a combination of what you kind of hinted at already. Some profit taking. Stocks are up 2 years in a row. There's some sector and portfolio rebalancing going on. Fear of rates, not coming down as much. You have Goldman Sachs forecasting 3 rate cuts and others more. And yet the Fed came out and said, we're moving our dot plot to 50 basis points, not 100. And then when you look at the curve is the 10-year, right, is up 60 basis points in the face of 100 basis points cut. So I think the prospects for the investor are like, we may not be cutting rates as much as we think. We've got inflation sticky at 3.3%. If we're going to have a rally, it needs to be on earnings, and the stock market has it. And the Q4 should be pretty good. So I think this dip creates a buying opportunity.
Well, we did talk to one strategist yesterday, Dory, who said that, or at least posed the question, is that outlook for earnings, though, already priced into stocks coming off of this, 24% or so rally that we've seen this year in the S&P 500?
Yes, absolutely it is. I mean, the market's rich, right? We know that. But as, and when we kind of keep going back to the irrational exuberance speech, right, which took 4 years before the bubble popped. But that was a very different market. A lot of those stocks didn't make money, right? And so here we've got a rich stock market. We got high PEs. But when you look at Nvidia, and I'm sorry, we got to focus on Nvidia. It's the big monster. It's the big one of the Mag 7. It's driving the Mag 7, and Mag 7's driving S&P, and that's driving the market, right? So you have to have an opinion on Nvidia. But, if you can get that stock at 30 to 40 PE, and the outlook is still very rosy for it, and you're talking about a company that makes 56% net profit margins and 120 some odd percent return on equity, and it's growing like crazy, and all the other Mag 7s are dependent on it, that's way different than what we had in 2000. And until I see a robust, excessive M&A market and excessive IPO market, I think you can hug into some good quality stocks when they dip and still do just fine.
All right, Nvidia is a kahuna. I want to talk to you about the kahuna of the bond market, the 10-year yield, which has risen, as you note, since the Fed started cutting rates. We've also seen the dollar, just mentioned the dollar. That has risen to multi-year highs. That has been pressuring risk markets as well. What do you see coming in the following year for rates and the dollar?
Yeah, Jared, I think that's a good point. No one is talking about the possibility of raising rates. Okay. And I think that is a very real possibility, looking at what's going on if this thing keeps heating up. So that 10-year is going to put a break, which is what I think your implication is. That's going to put a break on the stock market for going up and cause these growth stocks to, limit some of their upside, at least in the short term.
We always talk about the Fed being data dependent. What do you think would lead to a hike? And I believe you think we could still get a couple of cuts this year, but then perhaps the beginning of a new hiking cycle. What do you think that looks like? What are the circumstances?
I think so. Now to me, and of course it's hard to say, and the Fed sees different data than I do, but I know this, the Fed doesn't trust the data any more than I do. And so they're flying in the dark a little bit. But I'd like to see them pause a little bit to get a little more information. But they've had a tendency to jump out there. I thought the 50 basis point cut was a jump. I'm not sure if we needed this last one. I'd like to see them pause and get more data. But absent that, this scenario of cutting rates and then actually having to come back around and raise rates is a very real possibility. So if you see inflation take off, that's the first thing that they're monitoring. Then that's going to tell them, whoops, we're going to have to do a turnaround.
All right, Dory, enough on the chips and Nvidia. Want to focus on some of the other parts of the market here. Energy is leading today. I know you're looking at that. And banking as well. XLF, the large cap financials ETF, one of the top ETF returns of the year. What do you think of some of the other sectors?
Yeah, absolutely. Well, you can tell by my accent, I got to know something about energy just because I'm in Texas. But I think we still have a supply issue, and the energy guys, the oil and gas guys, they're not going to drill like crazy. The drill baby drill thing is gone. It'll be drill discipline drill, and they'll get a green light. It'll be really good, but they'll be disciplined about it because they're really worried about having capital to access. So I think we can see good, stable markets in energy going forward. Develop some energy independence here. And, within 6 months to a year, maybe even see prices go up, which would be good. So it's probably a good time to jump into something like an Exxon that's real stable, gives you a nice, 4% dividend or something close to that. Then you can also get a higher dividend in something like Energy Transfer, or you can follow Buffett, and IXIC and probably do pretty well there. As far as banks go, I think the play is probably a little bit better in the community banks than it is the larger banks. We've lost a lot of the Trump bump that we had in the market and in banks, which got it. But the reason is still there, and that is an ease in regulation. That regulation has been extremely restrictive, and not only for banking and what it's doing, but in mergers and acquisitions. So you take a community bank that's growing, has good solid equity in it, has good margin, good deposits, and is able to acquire, and you can buy it at below a 12 PE multiple. I think it's a good market for that kind of business.
Dory, thanks. Some ideas for investors there, and Happy New Year to you.
Thank you.